There's so many types of loans out there. Which one is best for helping you buy and scale in investment real estate, especially with short-term rentals? Let's talk about it. Conventional loans. This is how we started. Yeah, I know I'm not great at that, but hopefully you're still listening. Conventional loans are our very first investment properties. I actually just posted about this. That's how we started. We bought it with a conventional investment loan, and we did 15% down payment on that loan. Right now, it's really hard to get a conventional 15% down payment loan.
It's definitely a no for me, dog.
In fact, I don't even know if you can. I think everything's about 25% for the conventional loan type. So how do you get access to these loans? It's dependent on the individual. And that's what we're going to hit on with all the other loan types we're going to cover today. These loans are simply based on the buyer's credit worthiness. Do you have good income? Looking at specifically a debt to income ratio, they want to typically see that you're under 45%. Meaning if you have $100,000 a year of money coming in, they want to make sure that your total expenses do not exceed $45,000 a year. Additionally, they want to make sure you have enough money for the down payment and some reserves. So the 15% of the purchase plus typically 3 to 6 months of the mortgage cost. Let's say it's $1,000, another $3,000 to $6,000. Obviously, in this market, that's pretty low, and that's probably double that now. Now, what kind of interest rates do you get with a conventional mortgage? Typically, you're going to be right now at about 6.8 to 7.8% for a purchase. Now, if you're doing a refinance, that's how we do all of our BRRRR strategies, buy, rehab, rent, refi. You usually will add another quarter point in cost to that refinance. Now, some other things people don't think to ask about is, are there maximum loan amounts? And there are. And with conventional, it can still depend on the state and county that you're in. But typically, for most areas, we're looking at about a $726,000 conventional maximum. There's also the FHA loans and the VA loans. VA loans are for people that have served in the military. What's really cool about those is they can get as low as a 0% down payment. Zero. What a great opportunity to get into a house without spending a ton of money.
Thank you for your service.
So for FHA, you can have as little as a 3.5% down payment, which is, again, one of the lowest you can have when it comes to investment properties, second only to the VA loan types. If you're buying a residential multifamily, a 2 to 4 unit property, and use the FHA or the VA loan, those are your lowest down payment options while still having a great interest rate comparably to all of the other standard loans that are available for investment products. Right now, it looks like interest rates are ranging from 6.5 to 7.8%, a little bit higher than conventional, but still pretty good. And typically, people who are using FHA and VA, they need a lower down payment, and sometimes they have a couple of credit issues. So these can be really great options for those folks. Now we're going to get deeper into the products that I really like. Why? Because these are the things that have allowed me to scale. Here's some things that you don't know about the conventional loan products. They're limited. Yes, they're limited. You can only have up to 10 finance properties that are conventional. So what does that mean? Yeah, I guess if you're building a portfolio of less than 10, go that route. But for people that are really looking to scale and get deep into investing, have many units, it's not going to be the best product, and it's certainly not the end. You're going to need a different loan type to stay viable and investing further. And these are where the fun ones come in. This is where the beginners become veterans and the veterans go pro.
I'm the man.
So fix and flip loans. These are great. The first time I used one, I was like, this is crazy. 10% interest. Are you kidding? What an idiot. I'm so stupid. And now I go,
they were so expensive.
Of course I'm going to use a fix and flip loan. I don't even think about it. Why? Because that's the difference when you go from beginner to veteran to pro.
This one seems legit.
At some point you start realizing this is a tool, and if you use the tool well, it's great.
That's how it works.
So with the fix and flip loans, typically they're going to look at the individual's credit or their business credit. So it's a little bit different. They're not really tying the loan to the financial capacity of the individual. They're more focused on investing and lending on the assets capacity to do well. The lender is actually going to be focused on what is the potential after repair value versus the as is value on the property, and how much money does the individual want to borrow to improve the property so we can get to the after repair value. So for instance, the lender is going to go, okay, great. We're willing to lend to you on this property, but let me ask you, how much are you buying it for? How much is it going to be worth once you're done? And how much is that rehab going to cost? Let's say we're buying a property in an area where most of the homes are worth over $200,000. And somehow we've been able to negotiate a deal down to $100,000, which is half of that value. And then what's cool about the fix and flip product is they will lend to you the rehab budget as long as it makes sense compared to what what the total after repair value is. So when I talked to this lender, the lender said, well, how much is it worth? I'm like, it's worth probably 200, 225. So they said, you know what? After our review, we think it's worth at least 200. So we're going to go ahead and presume that this ARV, the after repair value, is 200. So they said, okay, 10% down for the 100,000. And then we're going to lend you the rehab budget. How much do you need? We said 50,000. They said, okay, 50,000. So if we're at 100 plus 50, that is 150,000 out of 200. And coincidentally, their loan to value maximum is 75%. So it was a perfect deal for us to do a fix and flip loan on. So how much money did I spend to create a $200,000 asset? $10,000 in down payment for the down payment of the purchase only. So I put $10,000 into this property. Then I created an equity of 50,000. So 10,000 versus the 50,000, I potentially 5x'd my investment. This is why fix and flip loans are so powerful. So naturally, even though we have such a low amount of cash invested in this product, fix and flip loans, these loan types are only viable for 6 months to 2 years, depending on the terms you set up with the lender. So how do you exit them? So knowing that we have a maximum amount of time that we can even hold this loan, we know that we have to exit this. So there's two ways to exit. You either sell it, probably as a flip, or B, you do a cash out refinance, where you work with another lender to actually buy the loan from the fix and flip lender so that they can hold the debt. What's the benefit? The benefit is now that lender, if they deem it's a good asset and you are a financially worthy individual, they're going to say, hey, this is a good bet for us. We're going to go ahead and hold this debt, and they'll hold it for 30 years. You went from a maximum of a 6 month to 2 year term all the way to a 30-year term. Now you can actually hold this as an investment property. Another loan that you can use to acquire properties are DSCR loans. So similarly to how the fix and flip loan focuses on the asset's value, the DSCR loan, the debt service coverage ratio loans, they focus on the income potential versus what the cost to hold the property is. So they're trying to make sure that debt service is covered by income. That's what that actually means. So right now, rates and terms can vary a lot, almost by a full 3% spread of 7 to 10%. Down payments can also vary, but typically right now with most lenders, you're seeing 15 to 20% down payments. The DSCR loan is excellent for all investor types. As an example of what the DSCR ratio looks at, for instance, if they figured out that the mortgage is going to be $2,000 a month to hold it, they're like, hey, we need to have a multiple of that to make sure that it's going to always be covered, right? So if you can show them data from either your long-term rental, mid-term rental, or short-term rental where it should make at least $3,000 in income, they're going to look at $3,000 over $2,000. That's a $1,000 spread, right? What they look at it like is it's a 1.5x multiple because it's getting 50% more money than the actual cost to hold the property. So for a DSCR lender, they're like 1.5x all day long. If you ever have a property that where you think where after the mortgage, including the tax and insurance, can be beat out by 50% or more, a DSCR lender will be happy to look at that deal. Bank statement loans are also cool. At one point, I thought they were super weird and I was like, I would never use these. And guess what? I used my first one this year. These are incredible for self-employed and high tax write-off clients.
Ballers only.
Especially for purchases that are on the jumbo level, anything over $726,000. Most bank statement loans can be done with as little as 10% down payments too. That's also a fantastic feature of what the bank statement loan can do.
That's nice.
And with the right smaller credit unions, sometimes you can get as low as 5%. I know, it's crazy.
How do they do that?
So get this, back when I was buying my new primary, which is a pretty expensive house, I was going down the lines of a jumbo loan because we were over that 726 mark. Now, when I was doing that, what I found out was in conventional loans, they still will allow you to add back all your depreciation if you have a bunch of rentals, which is great. But with this particular lender, when I tried to do my add back of depreciation to make sure my debt to income ratios were looking good,
How dare you?
most jumbo lenders do not allow add back of all of that depreciation. So it actually showed that my income was terrible. Wah, wah. So at that point, I was stuck. I was like, I got to figure out a way to make this work.
You can save us.
So that's when I remembered, wait, there's that bank statement loan thing. I wonder if that could work for me now. So when I went to the bank statement loans, guess what? They don't care about your depreciation. They care about one thing.
Show me your papers, now!
What are your total deposits over a 12 to 24 month period in your bank statements? They don't even really look at what your debits are. If you are in buy and hold rentals, there's no way you don't know about cash out refinance loans. These can be conventional, these can be portfolio, these can be debt service ratio based. Cash out refi is just a different type of loan, but it can be under any of the categories previously mentioned, aside from fix and flip. These are exactly what you use if you are doing the BRRRR strategy. And in that same vein, to get these types of loans, it can be dependent on either your financial and credit worthiness and or the property's income or equity value. Interest rates will always vary, but right now we're seeing about 7 to 9%. As for down payment, typically there is none because you're pulling the equity out of the property that you already bought or own. There are still going to be costs to do the loan though, so don't forget that. And maybe those costs are 1 to 3.5% of the loan amount. So keep that in mind when you do perform a cash out refinance. You might end up bringing $0 to the closing table because you have so much equity. They put the cost of the loan against the equity and boom, you have $0 to bring in. As for maximum loan amounts, typically you're at 70 to 75% of loan to value. There are some lenders out there and some relationships that can afford you 80 to 85%, however, on a cash out refi. If you can find those, never, ever, ever leave them. Those are amazing relationships.
I love you.
If you know some of those 80 to 85s, I want to know, please. I'll pay you. I won't pay you, but I'll thank you publicly. It's good to know that all loans, terms, and conditions can change sometimes by the day. By the time you see this video, these rates have already gone up and down 10 different times. So whenever you're looking for a new loan type or lender, talk to them about their best rates, what options you have for locking down the best rate, and when to do the rate lock if possible. Not all lenders do rate locks. So wrapping up, after talking about all these loans, I think that any of these loans can be great picks for people starting off in an investment, except for the cash out refi, because that's a part two. You can't really get to a cash out refi until you own one, right? So that being said, when it comes to scaling, I really encourage you guys to check out the DSCR loans and the fix and flip loan. Get comfortable with those. Don't be like I was. When I started, I was afraid. I was like, oh my God, high interest, high this, high that. I made it a big deal and honestly prevented me from growing and scaling even faster. The truth is, if you always play in the safe, you'll always be limited too. You won't have the experience and comfort to branch out and really learn some great things. So keep an eye on all these loan types, get educated and start using them. Good luck. And if you ever have questions, feel free to shoot them below. And please, please, please like and subscribe, share it with your friends. If you ever have questions, I really want to be out there being super educational and helpful to all of you. See you in the next video.